Something is happening to the American middle class right now, in April of 2026, that is not showing up in the headline economic data. It is not showing up in the unemployment rate. It is not showing up in the GDP number. It is not showing up in the record first quarter bank earnings that every major financial institution reported this week. It is showing up in a set of numbers that are scattered across Federal Reserve databases, credit agency reports, and household balance sheet data, numbers that nobody has assembled into a single picture and explained in plain language, but that, when assembled, describe something that is not a recession and not a crisis in the conventional sense. What they describe is a silent wealth shift, a slow, systematic, structurally engineered transfer of purchasing power, asset ownership, and financial security from the 80% of Americans who work for wages, save in bank accounts, and store their wealth primarily in their homes, to the 20% whose wealth is primarily in financial assets, equities, private credit, and other instruments that inflate when money is printed and hold value or appreciate when everything else deteriorates. This wealth shift is not new. It has been operating for 4 decades. The middle class's share of total American wealth fell from 37% in 1990 to 26% by the most recent Federal Reserve data period, according to USA Facts calculations using Federal Reserve and Census Bureau data. The top 20% of Americans held $97.9 trillion in wealth, while the middle class held $35.7 trillion. The top 1% alone held $35.8 billion, more than the entire middle class of the United States combined. And the Federal Reserve's distributional financial accounts confirmed in data published January of 2026 that the top 1% of households owned 31.7% of all United States wealth in the third quarter of 2025, the highest share on record since the Federal Reserve began tracking household wealth in 1989. But here is what makes the current moment different from every other year in the past 4 decades of widening wealth inequality. The silent wealth shift is not merely continuing in 2026. It is accelerating. Every single macroeconomic force that has emerged since the beginning of 2026 is structured to benefit the top 20% of wealth holders and penalize the middle 80%. The Hormuz oil shock driving gasoline up 39% since February 28th. The inflation resurgence now projected at 4.2% by the OECD for the full year. The Federal Reserve locked out of rate cuts by stagflation, leaving credit card rates at 21 to 23.75% average APR, according to LendingTree April data. The housing reset producing 3 consecutive years of projected price declines in the markets where the majority of middle-class equity is concentrated. The private credit crisis gating ordinary investors out of their own money while institutional clients with the right relationships maintain access. The K-shaped economy documented by every major bank and the Federal Reserve itself, where high-income households see 3% wage growth and lower-income households see 1.1%. The skunk at the party that Jamie Dimon warned about on April 6th of 2026 is not primarily an abstract economic risk. It is a lived financial reality for the 80% of Americans whose net worth depends on wages, home equity, and cash savings, rather than on the financial asset appreciation that is simultaneously enriching the top 20% at the fastest pace in recorded history. And the specific convergence of forces active right now makes the current period the most dangerous for middle-class financial survival since the 1930s. This video is going to show you precisely how the silent wealth shift works, through what specific mechanisms it transfers wealth from the middle class to the financial class, why the current configuration of inflation, debt, housing, and credit makes the mechanism more powerful than at any previous point in modern history, and what the specific actions are that have historically protected middle-class households from the wealth shift during previous cycles of this magnitude. Every data point in this video is verified, sourced from the Federal Reserve Bank of New York Household Debt and Credit Report, the Federal Reserve Distributional Financial Accounts, CBS News Federal Reserve Wealth Data Analysis, Inequality, Org Federal Reserve Data Analysis, USA Facts, LendingTree, the Global Statistics Credit Card Analysis, Get Out of Debt Research, US Bank K-shaped Economy Analysis, Fortune, MoneyWise, and current April 2026 market and economic data. Let us start with the specific architecture of the silent wealth shift, because understanding how it operates mechanically is the foundation for understanding both why it is accelerating and what can interrupt it. The silent wealth shift operates through 4 interconnected mechanisms that are invisible individually but devastating in combination. The first mechanism is inflation erosion of cash savings. The second is debt servicing costs that transfer income from working families to financial institutions. The third is asset class divergence that inflates the wealth of equity holders while suppressing or deflating the wealth of home equity holders. The fourth is wage suppression relative to inflation. that ensures the middle class never fully recovers the purchasing power lost during each inflationary episode. Let us examine each mechanism in the specific context of April 2026, where the data is freshest and the acceleration is most visible. The first mechanism, inflation erosion of cash savings, operates with mathematical precision that most people understand in theory, but fail to track in practice. The Federal Reserve's own data shows that the typical middle-class household stores the majority of its liquid savings in bank accounts, money market funds, and certificates of deposit. These instruments pay interest rates that, in the current environment with the Federal Reserve holding rates at 3.5 to 3.75%, range from approximately 4 to 5% for the best available products. Meanwhile, the OECD is projecting United States inflation at 4.2% for the full year of 2026. The University of Michigan's Consumer Survey, released in early April of 2026, showed consumer inflation expectations jumping to 4.8% over the next year, up a full percentage point from March's reading. If inflation runs at 4.2 to 4.8% and your savings account is paying 4 to 5%, your real after-inflation return on cash savings is approximately 0 to negative 0.5% every year, silently, without a single headline declaring that your savings account is losing you money. But it is. For a middle-class household with $40,000 in savings, earning 4% while inflation runs at 4.5%, the real purchasing power loss is approximately $200 per year. Over 10 years, a compound real return of negative 0.5%, the purchasing power of that $40,000 savings balance falls to approximately $38,000 in today's dollars. This is not catastrophic in isolation, but it compounds. The middle-class savings that were accumulated during decades of lower inflation are slowly losing their real value in an environment where wages are not keeping pace, where the Federal Reserve cannot cut rates to help, and where the alternative investment options that would preserve purchasing power require financial sophistication and access to markets that the middle class does not uniformly have. The second mechanism is debt servicing, and this is where the silent wealth shift is operating with the greatest force right now. Total American household debt reached $18.8 trillion in the fourth quarter of 2025. Mortgage balances, $13.17 trillion. Credit card balances, $1.28 trillion. Auto loan balances, $1.67 trillion. Student loan balances, $1.66 trillion. Total debt grew by $740 billion in a single year. And 4.8% of all outstanding household debt is in some stage of delinquency, the highest since before the 2008 financial crisis, according to the New York Federal Reserve's February 10th report. The credit card component of this debt is the most acute expression of the wealth transfer mechanism because the interest rate on credit card debt at 21 to 23.75% average APR is not primarily a reflection of credit risk. It is a reflection of market power. JP Morgan Chase, Bank of America, and Citigroup, which control the majority of outstanding credit card balances, are charging families 21 to 23% interest to borrow money that the Federal Reserve is providing to banks at 3.5 to 3.75%. The spread between what banks pay to access capital and what they charge ordinary American families for that same capital is approximately 17 to 19 percentage points. Every dollar of credit card debt an American family carries transfers approximately 21 cents per year to a financial institution. Across $1.28 trillion in outstanding credit card balances, that represents approximately $267 billion annually flowing from American households to financial institutions as interest payments. The data on what this credit card debt is financing makes the mechanism even more damning. The credit card statistics published in February of 2026 document that approximately 55% of credit card debt finances essentials, groceries, rent, healthcare, and utilities. Not discretionary spending, survival. An American family that is charging 55% of its credit card balance to buy groceries and pay rent is not making a lifestyle choice. It is living in an economy where the gap between what wages provide and what survival costs has been permanently widened by decades of wage suppression, and is being widened further every month by the oil shock that has pushed gasoline up 39% since February 28th of 2026. That 55% of credit card debt, the survival debt, is generating 21% annual interest that flows directly to the largest financial institutions in the world, while the families paying it fall further behind every month. The credit card delinquency data reveals the trajectory. Bow. The 30-day delinquency rate has been declining in aggregate, which sounds positive until you understand the K-shaped reality underneath it. The overall delinquency improvement reflects tighter bank underwriting. Banks have reduced the subprime origination share from 23.3% to 16.4%. Between the first quarter of 2022 and the first quarter of 2025. Fewer approvals for risky borrowers means fewer defaults in aggregate. But the 90-day plus delinquency rate of 12.4% in the third quarter of 2025 is the highest since 2011, nearly double the peak delinquency rate during the 2008 and 2009 financial crisis. And adults aged 18 to 29 are transitioning into 90-day credit card delinquency at roughly 3 times the rate of borrowers aged 60 to 69, according to New York Federal Reserve analysis. The generation entering the prime wealth-building years of their lives is doing so carrying the heaviest credit burden of any generation in modern American history, at the highest interest rates in 4 decades, at a moment when the housing market is declining in the markets where they would need to buy their first home. The third mechanism, asset class divergence, is the most structurally important and the most systematically ignored in mainstream discussions of the wealth gap. The Federal Reserve's distributional financial accounts. Data documents that the top 1% of Americans holds more than 50% of the national wealth invested in stocks and mutual funds, up from 40% in 2002. The bottom 90% of Americans, by contrast, hold the majority of their wealth in their homes. This asset class distribution produces a specific and powerful wealth transfer mechanism every time the Federal Reserve engages in quantitative easing, every time interest rates are cut, and every time central bank policy inflates financial asset prices. When the stock market rises, which it did by an average of 20% per year for 3 consecutive years, leading into 2026, the wealthy get wealthier at a rate that far exceeds any wage gain the working class receives. And when the housing market declines, which the American Enterprise Institute is projecting at negative 1% in 2026 and negative 2% in each of the following 2 years, the middle class, whose primary wealth storage is their home equity, loses the one asset that was supposed to be the foundation of their financial security. The CBS News analysis of the Federal Reserve data, published January 21st of 2026, made the specific mathematics visible. The wealthiest 1% held approximately $55 trillion in assets, roughly equal to the wealth held by the bottom 90% of Americans combined. And the driving force behind the recent acceleration of the wealth concentration, according to Mark Zandi of Moody's Analytics, was surging stock prices driven largely by artificial intelligence investments. 87% of Americans who own stocks live in households earning $100,000 or more annually, according to Gallup. The stock market boom of the past 3 years made people with 6-figure plus incomes dramatically wealthier. It did nothing for the majority of American families. And then the Bank of America data confirmed the wages dimension with a precision that belongs in every conversation about the wealth gap. Higher income households saw their wages grow at 3% in December of 2025. Middle income households saw 1.5% wage growth. Low income households saw 1.1% wage growth. With inflation running above 3% and projected at 4.2% for the full year of 2026, the real wage growth for middle and lower income Americans in 2025 was negative. Wages went up 1.5%. Prices went up 3%. Every middle-income American's real purchasing power declined. Every year that pattern repeats, the wealth gap between those who earn income from financial assets and those who earn income from wages widens further. The fourth mechanism, debt trap compounding, is the specific new acceleration that makes 2026 materially different from every previous year of the ongoing wealth shift. Credit counseling agencies, the organizations that families turn to when they can no longer keep up with their debt obligations, reported in February of 2026 that their clients in 2026 now average $70,000 in household income with $35,000 in unsecured debt. Double the pre-pandemic ratio. These are not people living on minimum wage. These are middle-income Americans, people with bachelor's degrees and professional jobs who have spent the past 4 years using credit to bridge the gap between what their wages provide and what their cost of living requires. Every dollar of that $35,000 in unsecured debt at 21 to 23% APR represents approximately $7,000 to $8,000 per year in interest payments that will consume income that could otherwise be saved, invested, or used to build equity. The debt trap, once entered at this scale, is structurally self-reinforcing. The interest payments prevent the savings accumulation that would allow the debt to be repaid. The debt grows, the interest payments grow, the savings rate falls toward a zero. And the wealth that the family could have been building instead flows to the financial institution holding the debt. Check, verified, undeniable. Now let us look at 3 historical episodes where the silent wealth shift operated at comparable intensity and what happened to middle-class financial security in each case, because the historical record provides both the magnitude estimate and the recovery timeline that current households need to understand. The first historical episode is the 1970s stagflation decade. When oil prices surged following the 1973 Arab oil embargo, and again after the 1979 Iranian Revolution, inflation in the United States peaked at 12.3% in 1974 and returned to 12% by 1980. For middle-class American families, this decade was economically devastating in ways that took a generation to recover from. Real wages fell. Housing prices, while nominally rising with inflation, did not increase enough in real terms to offset the purchasing power destruction of double-digit inflation. Credit card debt, though far smaller in aggregate than today, carried high enough interest rates to trap many families in debt-servicing spirals. The most accurate summary of what happened to middle-class wealth during the 1970s stagflation is this. Families that owned fixed-rate mortgages at pre-inflation interest rates benefited from debt erosion, as their mortgage payments became worth less in real terms. But families that needed to buy homes at the new higher prices, that needed to borrow at 1980s 20% mortgage rates, that carried consumer debt at high variable rates, that stored their wealth in savings accounts paying below inflation rates, those families lost a decade of wealth building. The middle-class share of total American wealth peaked in the mid-1980s, precisely because the 1970s inflation destroyed the savings of the working class, while the wealthy held assets whose nominal values rose with inflation. The second historical episode is the 2008 to 2012 housing crisis and its aftermath. The Federal Reserve and Treasury intervention in 2008 and 2009 deployed approximately $7 trillion in emergency support to the financial system, preventing the collapse of the major banks and the broader financial system. That intervention was necessary and appropriate to prevent a complete economic breakdown. But its distributional effects were profoundly tilted toward the wealthy. The Federal Reserve's quantitative easing programs, which purchased trillions in mortgage-backed securities and treasury bonds, drove asset prices dramatically higher. Stock markets, which had fallen 50% from peak to trough during the crisis, subsequently tripled between 2009 and 2013. Wealthy Americans who held equities through the crisis, or who bought at the bottom, recovered and exceeded their pre-crisis wealth levels within 4 years. Middle-class Americans whose primary wealth was in their homes watched those homes fall 15 to 30% in value in most markets, with some markets experiencing declines of 50% or more. The home equity that represented the majority of their net worth was destroyed. And when the Federal Reserve's quantitative easing inflated stock prices to recover the financial wealth of the top 20%, there was no equivalent intervention to restore the home equity of the bottom 80%. The wealth gap reached its widest recorded level in the years immediately following the financial crisis for exactly this reason. The policy response to a crisis driven by financial system excess primarily benefited the financial class and left the middle class to absorb the housing equity losses without equivalent compensation. The third historical episode is the most recent and the most instructive. The post-COVID inflation cycle of 2021 through 2025. The Federal Reserve's pandemic response deployed approximately $9 trillion in asset purchases and near-zero interest rates. The immediate impact was again profoundly K-shaped. Stock market indices tripled from their pandemic lows. Housing prices rose 40% nationally. Both of these benefited the top 20% of wealth holders who own the majority of financial assets and real estate. For middle-class families, the pandemic era produced a period of apparent wealth improvement as home values rose, and pandemic-era stimulus provided temporary income support. But the inflation that the stimulus and quantitative easing produced, peaking at 9.1% in June of 2022, then consumed the nominal wage gains and nominal asset appreciation of the middle class through the purchasing power destruction described in the first mechanism. By 2024, when inflation had moderated, but prices remained 25% higher than before the pandemic, the middle-class families that had appeared briefly wealthier on paper discovered that their nominal home equity gains had been consumed by the higher cost of everything else. And the 30% who did not own homes at all, who were renters unable to access the housing equity appreciation that benefited their neighbors, received nothing from the asset price inflation except higher rents. Now, let us understand the specific configuration of forces in April of 2026 that makes the current wealth shift acceleration more dangerous than any of the three historical episodes above. The current episode combines all of the destructive elements of each historical predecessor simultaneously. From the 1970s stagflation, it takes the oil shock-driven inflation that locks the Federal Reserve out of rate cuts, the wage suppression relative to rising costs, and the purchasing power destruction of cash savings. From the 2008 financial crisis aftermath, it takes the extreme concentration of financial wealth in the top 20% and the ongoing housing equity erosion in the markets where middle-class wealth is concentrated. From the post-COVID cycle, it takes the accumulated debt burden, the highest credit card balances in recorded American history at $1.28 trillion, the student loan delinquency surge from under 1% in the fourth quarter of 2024 to 13% by the second quarter of 2025, following the policy changes that ended forbearance protections, and the expectation of middle-class financial resilience that has been systematically destroyed by 4 years of inflation running above wage growth. The specific new element in 2026 that was not present in any of the previous episodes is the artificial intelligence-driven labor market disruption that is operating simultaneously with every other pressure. The K-shaped economy documented by U.S. Bank's March 2026 analysis explicitly identifies AI advancement as a force that is boosting productivity in capital-intensive sectors, further reinforcing advantages for firms and workers with specialized skills, while the benefits of innovation remain concentrated among larger corporations and high-income households. The first quarter of 2026 saw 294,000 jobs cut across 92 companies. Amazon cut 16,000. Oracle announced 18% workforce reductions. Meta cut more than 20% of employees in certain divisions. These are not low-wage jobs. They are middle-class professional jobs in technology, finance, marketing, and administration. The people losing these jobs in 2026 are the same people who would otherwise have been the primary candidates for the kind of middle-class wealth building that the American economy has historically supported. They are entering the job market at precisely the moment when AI is compressing wages in their fields, housing is declining in the Sunbelt markets, where many of them bought homes, credit card rates are at 21 to 23%, and the inflation from the Iran war is consuming purchasing power at a rate that wage growth cannot match. The retirement dimension of the silent wealth shift is the most hidden and the most permanent piece of damage. The Federal Reserve data shows that more than 1/3 of Americans who work full-time have no access to pensions or retirement accounts, such as 401k plans that derive their value from financial assets like stocks and bonds. For the 63% who do have access to these accounts, the performance of their retirement savings is deeply dependent on the performance of financial markets. The S&P 500 peaked on January 28th of 2026 at 6,979 points and has fallen 7 to 9% from that peak. The software sector ETF IGV is down 30%. The Magnificent Seven stocks, which represent approximately 1/3 of the index's weight, have collectively fallen 15% or more from their highs. For a middle-class worker with $100,000 in a 401k account, a 15% decline represents $15,000 in paper losses. In percentage terms, that sounds manageable. In absolute dollars, that is a year or more of savings for a typical middle-class household. And the paper losses become permanent if the account holder is forced to withdraw from the account early at a depressed price because the combination of unemployment, credit card debt service, and oil shock energy costs has exhausted every other source of liquidity. This is the specific pathway by which the silent wealth shift wipes out middle-class savings, not through a single catastrophic event. Through the compounding interaction of multiple simultaneous pressures that exhaust each available financial buffer in sequence until the retirement account is the last resource standing, and then that resource is liquidated at the worst possible time, locking in the paper losses permanently and resetting the wealth-building clock to zero. The data on savings rates confirms this trajectory with disturbing precision. The Primerica survey documenting that 82% of middle-income households cut down on the amount they were saving or reached into existing savings to make up for the shortfall during the peak inflation period of 2022 is not a historical artifact. It is the initial warning that the savings depletion cycle was beginning. 4 years of inflation running above wage growth, 4 years of housing costs consuming more than 30% of median household income, 4 years of credit card balances growing because wages do not cover survival, 4 years of student loan payments resuming after pandemic forbearance ended, and now a 39% gasoline price increase in 6 weeks. These are the sequential buffer exhaustion events that reduce a middle-class household from savings accumulation to savings depletion to debt accumulation to debt trap. The Primerica 82% figure from 2022 has become the normalized condition rather than the temporary emergency. The top 1% of families, by contrast, save approximately 35% of their income, according to the research of Emmanuel Saez and Gabriel Zuckman, versus effectively zero for the bottom 90%. 35% of income saved and invested in financial assets that have appreciated dramatically over the same period when middle-class savings were being depleted. The compounding of those savings across decades at the returns available to the top 1% through private equity, hedge funds, and concentrated stock ownership produces the 31.7% wealth concentration that the Federal Reserve confirmed in the third quarter of 2025. It is not luck. It is the mechanical output of a system where the top percentile saves at 35% and the bottom 90% saves at approximately zero, operating across 40 years. Here's what every American family in the middle class needs to understand about the specific window they are currently inside, because the historical record gives a clear answer about what protective actions have worked during previous accelerations of the wealth shift. The first and most immediately actionable protection is the elimination of variable rate, high interest consumer debt before any other financial priority. Every dollar held in a savings account earning 4%, while a credit card charges 22%, represents an 18 percentage point daily destruction of wealth. The average middle-class family with $7,000 to $8,000 in credit card debt is paying approximately $1,500 to $1,800 per year in interest payments on balances it could eliminate today with its savings. Eliminating credit card debt before maintaining an emergency fund beyond 3 months of expenses is the highest return financial decision available to the vast majority of middle-class American households in the current environment. It is not exciting. It does not produce headlines. It is the specific action that the wealthiest Americans execute reflexively, and the middle class defers indefinitely. The second protection is understanding the specific asset class exposure that the silent wealth shift exploits and adjusting accordingly. The middle class stores 80% of its wealth in its primary residence. The primary residence is currently declining in 28 of the 53 largest American metropolitan areas. The primary residence cannot be diversified. It cannot be sold partially. It is illiquid, indivisible, and in many Sunbelt markets actively losing value. The protection is not selling the home. The protection is ensuring that the home is not simultaneously the only financial asset, while every available dollar above essential living expenses is directed toward instruments that have historically preserved purchasing power when the dollar's purchasing power is declining. The historical record of every currency crisis, every inflationary episode, and every civilization collapse documented in this series points to the same answer. The third protection is the most psychologically difficult and the most financially important, confronting the gap between nominal wealth and real wealth. A family whose home is worth $500,000 in a market where prices are projected to fall 2% per year for 3 years will have a home worth approximately $470,000 in 3 years. If that same family's mortgage balance is $430,000 today, the equity cushion is $70,000. After 3 years of price declines and mortgage payments, the equity may still be positive, but it will be smaller, less certain, and tied to an illiquid asset that the family cannot access without selling at the reduced price. The nominal wealth of home ownership in a declining market is not the same as the real wealth of having liquid, diversified, appreciating assets. The families that understand this distinction and act on it while the option to act still exists are the families that historically emerge from wealth shift accelerations with their financial positions intact. Here is the complete picture of the silent wealth shift that is operating in April of 2026. The top 1% holds 31.7% of all American wealth, the highest since 1989. The top 1% holds more wealth than the bottom 90% combined. The middle class's share of total wealth fell from 37% in 1990 to 26% today. American household debt reached $18.8 trillion, growing by $740 billion in 2025 alone. Credit card balances stand at $1.28 trillion at 21 to 23% APR. 55% of credit card debt finances survival needs, groceries, rent, and healthcare. 4.8% of all household debt is delinquent, the highest rate since before 2008. The 90-day plus credit card delinquency rate of 12.4% in 2025 is nearly double the 2008 peak. Adults 18 to 29 are entering severe delinquency at 3 times the rate of older borrowers. Student loan delinquency surged from under 1% to 13%. Credit counseling clients in 2026 averaged $70,000 income with $35,000 in unsecured debt, double the pre-pandemic ratio. Higher income wage growth was 3% in 2025. Middle income wage growth was 1.5%. Low income wage growth was 1.1%. Inflation is projected at 4.2% for 2026. Consumer inflation expectations hit 4.8% in April. Gasoline prices rose 39% in 6 weeks from the Iran war. The S&P 500 software sector is down 30%. Housing prices are declining in 28 of the 53 largest American metropolitan areas. The American Enterprise Institute projects 3 consecutive years of national home price declines beginning now. The Federal Reserve is locked out of rate cuts by stagflation. The top 1% saves 35% of income. The bottom 90% saves approximately zero. This is the silent wealth shift in its current configuration. It has been operating for 40 years. It is accelerating in 2026 because every single macroeconomic force active right now, the oil shock, the inflation resurgence, the housing decline, the credit card debt crisis, the student loan resumption, the AI-driven job displacement, the Federal Reserve paralysis, are all simultaneously and directionally pointed in the same direction, away from middle-class financial security and toward further concentration in the financial class. The silence of the shift is its most dangerous characteristic. It does not announce itself with a single crash that prompts government intervention and media coverage. It arrives in grocery store receipts that are $30 more expensive than last year, in gasoline prices that are $1.17 higher per gallon than 6 weeks ago, in credit card statements that show minimum payments growing while balances never shrink, in housing values that have stopped going up without yet going dramatically down, in retirement account balances that are lower today than they were when the year started, in wages that technically increased but somehow left everyone with less at the end of the month. The middle class does not end in a single dramatic event. It ends the way Hemingway described bankruptcy, gradually and then all at once. The gradual phase has been running for 40 years. The all at once is the current convergence. The question is not whether you see it happening. The question is whether you understand it clearly enough and soon enough to be among the families that preserve their position through it. If this video gave you the complete, verified picture of the silent wealth shift that no single source assembles with this level of data and clarity, subscribe right now because this is the standard of analysis I deliver every single week. The next video is going to show you the specific 10 financial decisions, ordered by urgency and potential impact, that have historically protected middle-class households from permanent wealth destruction during accelerations of the inequality cycle, with concrete data from the families that implemented them during the 1970s, the 2008 crisis, and the post-COVID inflation cycle. That is the practical implementation guide that follows this structural diagnosis. Subscribe, turn on notifications, and watch it the moment it drops. The shift is in progress. The window to act is open. Every week you delay, the math compounds further against you.